Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button and ring the bell so you don't miss our daily interviews with successful real estate investors. Our guest today is a money business insider, a longtime venture capitalist, and hedge fund manager who lives in a world like TV's Shark Tank. Since selling his publishing company to a Fortune 500, he keynotes conferences worldwide, delivering business strategies and the inside track for money and success to business executives and their teams. His work has appeared in the Los Angeles Times, Wall Street Journal, Forbes Small Business, Entrepreneur Magazine, Investors Business Daily, and the Los Angeles Business Journal. Joel Block is the CEO of Bullseye Capital. Joel, welcome to Purchase to Profits. It's great to have you on the show.
Hey, Seth, thanks for inviting me. How are you, man?
I'm doing quite well. I'm really looking forward to this. You're a guy with a long background and history of success, so I'm really looking forward to learning from you.
Yeah, I'll tell you, listening to that bio, it's a little too long. we got to trim it down a little bit, huh?
How about Joel knows his shit?
Okay, there you are. Listen, I leave that to you. There you go.
Yeah, perfect. So let's get started in talking about your real estate goals. I know you've built up a really successful business, but where are you looking now?
Well, I'm kind of looking at retiring from my fund. I run a fund. We have about 40 assets in the fund, or we did. We're liquidating a lot of those assets. And, the funds, run in cycles. And so, we set up a cycle that was 5 or 6 years. We've kind of run to the end of the cycle. And now it's time to give the investors their cash back. I'll probably start another fund, but I don't really this time want to control the real estate. I'd rather set up what's called a fund of funds. And what that means is that I'll take in some money, and then I'll find guys that I have a guy that has a fund here and another one there and another one there. And so I'll spread the money across several different guys, and that'll probably, it's a little easier way for me to run it. And because I know so many guys that have funds and I help a lot of guys set up funds, it's probably a better way for me to do it.
For sure. And plus you can golf a little bit more when you're doing that way too, right?
I can be on more shows like yours.
That's right. That's great. And, but let's go back in time when you were really starting to scale your business at the start. Obviously you were quite aggressive with growing it. Did you have set goals for targets you wanted to hit?
I can't say that I had targets per se. I had things I wanted to accomplish. I don't do that great when it's highly project driven, but I do better in things that are a little bit more abstract, like goals and themes. I'll give you, for example, okay. A lot of people do New Year's resolutions, and although I've got these terrible weather allergies, we've got like rain outside. Yesterday before it started raining, I was skinny like a rail. Today, I'm a little, just the weather thing happens. But listen, we all have a weight thing that we always try to take care of it first of the year. We do this. But rather, I kind of think about things in terms of themes. So rather than a New Year's resolution, say for example, just for me, instead of saying I want to buy 5 properties, what I'll say is that I want to go to the next level. So my theme for this year is the next level, and that's the next level in my personal life, my business life, my fund, whatever the next level is. And every year I kind of create a new theme for the year, and it really helps me in a big way. So it's kind of cool.
Gotcha. So what are some of the things you do maybe daily or monthly that keeps your theme top of mind?
It's changed over time as I've kind of evolved. It's kind of moved into some new stuff. But number one, I have it printed. I have it in a place where I could look at it every day. That's very important. I'm in the habit of making videos a couple times a week. So I make what I call Dear Abby videos. And the next level of a video, for example, is maybe make more videos or different kind of videos. And so I'll set up these things. And so Dear Abby is people write in and they'll say, Joel, as an expert in syndication, capital raising, and those things, they'll ask me questions about how this works. So for example, I was on the phone this morning with some guys who called to ask some questions. They were saying, if you have a fund, can you invest in other assets too? How much skin in the game do you need? Whatever. So those will be questions that I'll come out with videos. And, I just need to stay really true to the goals, true to the theme, and just the next level is really trying to stay on top of producing more videos and really doing more education, because more education produces, a bigger network and just all sorts of great things, and more network increases deal flow. I mean, lots of great things come out of having a great network. So, and that needs to go to the next level too, is the network needs to go to the next level. So you have to be really thinking about how you're going to do that. So I've got a lot of things on my plate that I want to make better, and they're already going pretty good, but there's always room for improvement, right?
So I'm curious, how does a guy with your stature and at your level right now take his network to the next level? Because I'd imagine your network right now is pretty substantial.
I do have a pretty good network, but you know what? There's always people at a higher level. And the goal in networking is to network up. You want to always be going to the next level. It's okay to hang out with people who are like you, and that's probably going to be the bulk of your network. But you also want to try to network to the next level. And you got to figure out, what do you bring to the table for somebody that has more experience, more money, more friends, more, whatever. And that might be, let's say you're trying to raise capital. How do you get around more wealthy people? Wealthy people tend to be with wealthy people, so you got to get around wealthy people to begin with. And so how do you get around more of those, more celebrity type people? How do you get around their business managers? How do you get around their managers and their agents? How do you get around all the people that make the decisions for them? That also means that you have to understand what issues are important to them, because if you don't understand their issues, then you could just be wasting a lot of time. And that would be really kind of a sad thing to do, is just to waste a lot of time, because we don't all have a lot of time to waste, right? So, if you're trying to get money out of a money manager and you don't pay commissions and he's driven by commissions, then you might be speaking a foreign language with one another, and that doesn't work out at all.
Yeah, no, for sure. And so as you were scaling your business, obviously you experienced some rapid growth. Did you have any strategies that thought would be a home run, or, a big success and turned out not to, work at all?
You got to throw a lot of crap at the wall. Some of it works, some of it doesn't work. And that's kind of like how life works. We're always trying new things. We're always trying new technologies. We're always trying new approaches. And some of those approaches work just great. Some of those approaches don't work at all. And so, yeah, there have been lots of things that have worked and lots of things that have not worked. And hopefully you find out what doesn't work pretty fast. In fact, I think there's a book that called Fail Fast, because it's kind of a strategy. You have to do a lot of stuff, figure out what doesn't work, stop doing that right away if you can, and then move on to the next thing. And that's really what the goal is to move on to the next thing as fast as you can. And that's what I try to do.
So Joel, is there one deal that really stands out from all the ones you've done, that's a keystone deal that really propelled you forward?
There are two, actually. Listen, we've all done dozens of deals. I've done about 40 deals in my career. The earliest one that really, of course, the first one stands out, and then the second one really stands out. Those two are really important deals. The first one, I was 25 years old, me and another young guy met each other. I had just quit working at Price Waterhouse, the big CPA firm, so I really kind of understood the technical aspect of putting money together, and he was a broker and kind of understood the deal, the real estate side. And we decided we were going to try and syndicate something ourselves. And we got on the phone, we cold called a bunch of doctors and raised $165,000 from 22 different guys. We probably broke every rule in the book, and I wouldn't tell anybody ever to do it the way that we did. But we did what we did, and that's how we got going years ago. But we got our first commission, paid for like a bunch of office furniture, and it kind of got us set up, which is awesome. And the second deal was really a big one. That we made a lot of money on that one. That was a really big one. We really sweated a lot. It was not an easy deal. In fact, we tied the property up this was in like 1987, by the way, so it's a long, long time ago. But we tied this shopping center up for $2.1 million, and we couldn't raise any money. I mean, we wrote a check for $25,000 on our line of credit that we had gotten, so we were on the hook. I mean, I think that was the whole line of credit. That's all we had, and we couldn't get the money from the investors that we went back to. That we kept trying new guys, go back to the few guys that had come in the first deal, and we just couldn't get any traction. So we called the seller and we said, look, sorry, it's not going to work out. Just please send us our money back. And she wouldn't give back to us. And we were like tears. I mean, it was a sad time. So we started thinking about how we could unwind this transaction. And we knew that at that time, the big concern in the marketplace was asbestos. So we had an asbestos test done, and they found a trace amount of asbestos. So we called the attorney and the woman, and we said we need an emergency meeting. In that emergency meeting, we revealed that there was asbestos on the property, and we couldn't buy the property. So give us our money back, and we'll just leave it alone. And the attorney, we didn't know this was a coincidence, had just gotten his butt kicked in an asbestos case And he says to the woman, he kicks us out of the room and he says, look, you got to, whatever they want to do, you got to get rid of this property. You got to get rid of it fast. So she ended up taking $400,000 off the purchase price, and we bought the property and, did what we did. And that was really our first big transaction. We made a lot of money on that deal, and that propelled us into the next level. So in a funny way, her not letting us out, it really kind of took us to the next level. And, sometimes you got to be willing to do some tough things and shed a tear or two, and that was it. But those are my great real estate stories. Then I launched into venture capital, and I've got a great venture capital story. And I mean, I've got a lot of great stories, and we don't have time for all of them. But it just this business, you can't be in this business without producing great stories.
Oh, for sure. I like that one. The asbestos. That's great. So, but how did you actually finally get the funds to close? Because I know you said you had trouble getting investors.
Well, so here's what happened. So, the rates of return at 2.1 million weren't that great, but at 1.7, they were pretty sharp looking. So we go back to the guys. Hey, listen, we just negotiated a $400,000 discount. Now, what do you think? Oh, wow, that's pretty attractive. So we ended up when we went back, the guys started liking the deal, and they gave us the money. So investors are smart. Investors know, hey, listen, this is going to be a 6% return. And when we reorganized the thing and basically chopped off the vast majority of financing, that we needed to take, because the woman was going to give us a decent amount of carryback financing, we ended up moving those returns probably to something in the mid-teens. So it turns out that we probably doubled the return, and then the investors got behind us and we moved forward.
Yeah.
So
that's a really good story.
They weren't saying they didn't like the property. They were saying they didn't like the numbers. We didn't do what they were telling us is that we didn't do a good job negotiating and putting the deal together. And we had to do a better job. So we had to go back to the table and put it together in a better way. And that's exactly what happened.
Yeah. So did you change how you were underwriting properties after that one to make sure, you were able to select properties and go in?
It certainly made us more sensitive to the needs of investors.
Yeah.
And you have to be sensitive to the needs of investors. What it taught me was that the deal matters. I mean, I was young. I was 25, 26 years old. I was learning. The deal matters. People care what it is. They care about the underlying asset. They care about the opportunity. They care about the rate of return. People have alternatives. And if you don't look like the best alternative or a very, very good alternative to them, then they're going to move on to something else. So some really good lessons came through in that situation.
Yeah. And I also I was going to say, I also like the fact, you're a young guy, you're going out, you put your money up to get the deal, and you didn't even have money lined up at that point. Right.
Well, that's the syndication business, so there's syndications and there's funds. A syndication is project-based, and in syndication, you don't have the money in advance. So you have to use your own capital. If you have to travel to look at a property, you have to use your own capital. If you got to do due diligence, it's your own capital. If you need a phase one, it's your own capital. No matter what you got to do, architect, engineering, whatever you got to do, you're laying out your own capital. A fund is different. A fund has the money in advance, and a fund has a long life. A fund is going to do multiple projects over a period of time. So when that happens, what that means is that the fund is going to advance the money for the project. And if the project doesn't work out, that's a loss to the fund. So there are different reasons that you would do a fund or you would not do a fund, and that's one of the questions people always ask is, when do you do a fund? And if people go to the library where I have all these little videos, the questions and answers, and I'll get you the link and you can post that. But if people want to watch those things and they want to really understand how you decide whether you're going to do a syndication or a fund or how you raise your money, I mean, we're talking about, this is what Wall Street does. I mean, Wall Street, they're really good at what they do. It's how I operate. I've been doing this for close to 30 years. I mean, I was trained by some of the best guys, and I've raised a lot of money in my day. So between all those things, it's there's a little bit of art to it, a little bit of science to it, and you have to really kind of understand the facts and circumstances of the situation. But once you understand it, then you can decide what the best course of action is going to be for you, and you go from there.
Yeah. At what point with your business did you switch from syndicating to starting a fund? Was it after you had a couple deals, or? Yeah,
you probably, here's the thing. For a fund, funds are harder to raise because people have to trust you more. Because you're blind. You're saying, okay, listen, we're going to find properties that meet these criteria. You don't get to look at them. You don't get to vote. You just give me the money now, and then I'm going to go do the best I can. And so they have to really trust you. So you have to have a little more track record in order to get a fund going. The other thing is, that when you have a fund, you've got people's money that's accumulating a preferred return, which is the payment that they get before you get paid. It's not interest. Interest is a contract, and if you don't pay interest, then you can be foreclosed on. A preferred return is best effort, so it's a little bit different. But you're still accumulating something that you have to pay to the investors before you get paid. So what you don't want to do is take in a whole bunch of money into your fund and then not have any deal flow. So if you're a person that doesn't have a lot of deal flow, a fund is probably not going to be good for you. So you want to make sure that you have lots of deal flow. You want to make sure that you have the ability to, park your money somewhere and make money on your money. And if you don't, then a fund is not a great vehicle for you. So your situation, people ask me, Joel, should we do a syndication or a fund? And those are the kinds of things that I ask people to figure out. Listen, let me understand, where's your money going to come from? What's your deal flow like? What's your experience? What's your background? What kind of relationship do you have with your people? And all these things put together help me understand whether or not they should have a syndication or they should do a fund or whatever is the right angle for them.
Yeah. And would you also say where you are at in terms of the market cycle plays a bit, like, a vulture fund during, 2008, 2009, those guys were able to, scoop up some properties.
And that's when we got started. Here's the other thing. A fund, your gun is loaded. The money is ready to go. So you walk in. Let's say, Seth, you walk to the table and you say, listen, I mentioned this property. This is what used to happen, 20 years ago. We walk in. It's a nice property. We like this property. We tie it up. They want $1 million. We'll give them $1 million, whatever the price is. And we'll be back in 4, 5, 6 months with the money. And they go, 4, 5, 6 months? What, are you kidding? So, but, 20, 25 years ago, that's how it was. Now, if you went, 4, 5, 6 months, they laugh at you. So a fund allows us to say, listen, we can do the due diligence. We can do everything. We can close in 2 weeks, but I want the property for $800,000. And that 200, so they might say, well, how about 825 instead of 800? You see what I'm saying? So what they might say is that they don't want to go all the way to the bottom, but they're certainly going to give us a significant discount for being ready. And that $175,000 that got made is a readiness premium. I mean, we got paid extra just for being ready. Just for being ready. Think about that. And that's why funds are so profitable, is because you're paid for being ready.
Yeah. No, that's definitely a good message. So Joel, you've built your successful real estate business. How has getting into real estate changed your life?
I love real estate. Real estate's a great business. I've been in venture, I've been in film, I've been in real estate. I've done a lot of different things. To me, they're all assets. I'm a professional investor and I move money across different things. To me, I'm more focused on the structure and the capital. And, I rely on people, who have deal flow in different categories. If it's a venture transaction, I'm especially well-skilled in analyzing venture transactions. So real estate, I kind of lean on some other people. But, to me, investments are investments. The bottom line is that we put money in and we want to get our money back plus more. And that's what we're looking for. So we're looking for what's the quality of the promoter, what's the quality of the deal, what's the marketplace look like, what are the economics surrounding the deal. And those are things that we think about. And people who are professional investors, that's what they think about. And there really are three big things that you would want to think about in terms of value-added investors. And most of us are value-added investors. Most smaller players are value-added investors. These big guys, they'll buy a AAA apartment building and they'll just buy it and they'll just take it for cash flow, right? But that's not what we do because there's not enough juice in those deals for us. So we'll buy a C property, turn it into a B property, and we'll just take cash flow out of it. But what'll happen is that we have to find a property that had some level of distress. Now, there's three kinds of distress. You have market distress, let's start at the beginning. You have property distress, which is the building, broken windows, broken toilets, missing sinks, whatever. You have owner distress. Owner distress is typically financing issues where the person is having a financial problem. Those two things, by the way, owner distress and property distress, go hand in hand. So when a building has lots of distress, you probably know the owner's got some problem that's allowing this to happen because they're about to lose control of their property. And the third kind of distress is market distress. In 2008, 9, 10, we came through a cycle of market distress. We might be getting ready for another cycle of market distress right now. Professional investors only invest in the first two. Only invest in property distress and owner distress because those are things that they can correct with their resources. Neither you or me knows when the market's going to correct. So we don't invest in market distress. There were a lot of people that would call me and say, Joel, in 2008, the market's so low, everything's on sale. It's not on sale for you. It's on sale for everyone. So, so you're not really getting a discount. And then what happens is, so everybody buys at the same price. If I was the only person on the block getting a deal, that's a good deal. But that's not what happens in market distress. And that's the reason that we think about it that way. So that's something for people to consider. And if people understand these things, by the way, then they really should think about, getting more money, because that means that they're good at what they do. If they're good at what they do, then they should start controlling more capital. I mean, listen, what's the most important asset in our economy? It's capital. It's money and capital. And if you learn to control the money and the capital, then you can, buy all the deals you want and make all the money you want.
Yeah. So if somebody's looking to learn how they can raise some capital and get some more information from you, where can they get a hold of you?
Well, twice a year we do a symposium, the Syndication Hedge Fund Symposium. There's nothing like it anywhere in the country. We've probably produced more syndicators, fund managers, syndications, and funds than probably anybody in the country. And what happens is that we take 50 very sophisticated people that you have to either be doing deals. If you're doing flips, you have to be really good at it. If you're you have to meet some criteria. Put it like that. I mean, we can go through what the criteria are later, or they're on our website at dealmakingsymposium.com. But the reason for the criteria are that there are no beginners, there's no wannabes. It's very sophisticated people, because if you don't bring a track record, if you're not sophisticated, if you can't demonstrate that you know what you're doing, you're never going to raise any money anyway. So why bother learning how to raise money if you're not going to be successful raising money? It doesn't do anybody any good for you to clog up a seat and then not be able to do what we want you to do. So, make sure you've got the background. But if you've got the background and go to the next level and makes sense for you, then our symposium is awesome. It's a remarkable thing. The next one's coming up in April 2019. And we would encourage people to go to Deal Making Symposium, take a look at it, and see if it might work for them.
Yeah, and I'll be sure to include the links right down below the video so people can just click and go to the website.
Right.
That's great. So Joel, just want to say thank you so much for sharing your success with us today. Really
happy to be here.
Yeah. And to you, our viewers, I wish you well in your journey from purchase to profits. See you next time.